Alright, so in this video we talked about credit vertical spreads, and I mentioned in that video that this is my bread and butter strategy. And that is because it has limited risk. It has a high probability of success, and I can use it to put time decay and volatility contraction in my favor. We talked about two kinds of credit vertical spreads, the bull put spread as well as the bear call spread. So in today's video, we're going to level up on our credit vertical spreads. We're going to be talking about one of the ways in which we can combine both the bull put spread as well as the bear call spread, and let's see what they can accomplish together. So the strategy we're going to be talking about is the iron condor, and this is the strategy when we execute one bull put spread along with one bear call spread. Now let's explore this using an example. So here we have a stock that has recently made a large downward movement. Now let's say I think that this stock is going to consolidate for some time. I may think the stock is going to stay above $30, so I can execute a bull put spread. At the same time, maybe I think the stock will not go above $40. So right here, I can execute a bear call spread. Let's say I execute a bull put spread by selling the $30 put and by buying the $25 put as protection. This is 2 months to expiration, and for this position, I will collect a premium of $92. Now at the same time, I'm going to execute a bear call spread. So I will sell a call option with a strike price of $40 and buy the call option with a strike price of $45 as protection. For this position, I will collect a premium of $97. So in total for both positions, I collect a premium of $189. And this basically is my iron condor. This is the payoff diagram of the iron condor that I have just executed. As long as the stock price stays between this $30 to $40 range over the next 58 days, I will make the maximum gain of $189. However, if the stock price moves above $45 or below $25, then I'm going to incur the maximum loss, which is $311. For this trade, I have a 50% chance of making a 61% return on my capital. So when I execute an iron condor trade like this, my goal is that the stock price will stay between the $30 to $40 range so that I can make the maximum gain on this trade. Alright, so this is the basic mechanics of iron condor trades. Now we will get the benefits of selling options. We will also get the benefits of credit vertical spreads. But there's more. Here are 3 more benefits we can enjoy when we sell iron condors. So the first advantage is that an iron condor is made up of 2 credit vertical spreads. So we are actually collecting the premiums from selling 2 spreads, but only taking on the risk of 1. What does that mean? Now from our earlier example, we know that I will only incur the maximum loss if the share price either closes above $45 or below $25. And there's no way in which both of these outcomes can happen at the same time. There's no scenario in which both of my credit spreads will be losing money on expiration day. Regardless of how the trade plays out, we are pretty much guaranteed the maximum profit on at least one of our 2 credit spreads. Ideally both, but at least one of them is going to be at maximum profit. So by selling iron condors, we can actually increase our return without increasing our risk. The second advantage is that we can actually use an iron condor to take a more conservative approach, and we can increase our probability of making the maximum return. How do we do that? We do that by widening our strikes. So back to our example, if I want to have a higher probability of making the maximum return, I can choose to widen the strikes of my iron condor. Perhaps now I can sell the 25-20 bull put spread and at the same time sell the 45-50 bear call spread. Effectively, what I've done is I've increased the range whereby I can make the maximum profit on this trade. Now there's a much higher probability that the stock price will stay within the wider range. I have a 72% chance of making a 16% return on my capital. 16% over 2 months, still pretty decent return. The third advantage is that Iron Condors is a very flexible and customizable strategy. So back to our earlier example, let's say by doing technical analysis, I have identified a very strong support line at $35. So maybe I think that there's a higher chance that the stock prices will remain above $35, and perhaps I want to give myself a little bit more room to the upside. So what I can actually do is I can sell the bear call spread that is further away from the current price compared to the bull put spread. And that gives me some room for the stock price perhaps to bounce off and to stay above that support line. Now I also can customize my trade based on the size of the spreads. I could sell a wider bull put spread and a tighter bear call spread so that my maximum risk is limited further in the event that the stock price makes a large movement upwards. Now, of course, nothing is perfect and there are also disadvantages and other considerations that we need to factor in when we are executing Iron Condor strategies. First of all, an Iron Condor is made up of 4 option contracts. So we're gonna have to pay more commissions to our brokers in order to execute them. So to mitigate this risk, make sure you're using a broker that gives you competitive rates and commissions for trading options. Secondly, we make the maximum profit if the stock price stays within a certain range. If the stock price makes a really big movement, one side of our Iron Condor can end up in trouble. So if you are expecting that the stock price could potentially make a very large movement, then it might be safer to just execute one credit vertical spread rather than an Iron Condor. What happens if the stock price moves outside the range of our Iron Condor? What can we do? We're going to talk about trade management in an upcoming video. You don't want to miss out on that, so make sure you are subscribed. So that's all for today's video. Like, comment, subscribe if you found this to be helpful, and I will see you again in the next video.